Our outlook for the dollar is positive. What does this mean? Can we make any money? Good question. We have a formula at Waddell & Associates, which is that reality minus expectations equals investment returns. Let's take a look at reality first. The reality is corporate earnings are improving briskly. And so this is a chart that goes back to 1999, a date I've chosen to show you that at the bottom for corporate earnings in 2009, we were basically back in 2001. So you wonder why it was a lost decade for stocks. It was a lost decade for corporate earnings as well. But now we've turned the quarter. Corporations are being very productive. There's a lot of cash flow, and earnings are growing pretty briskly. Valuations are fair. This is a chart going back to 1946 that shows you that the PE multiple on the S&P right now basically sits on the long-term trend line, which is about 17 times. If you look at forward earnings, and I mentioned this in an email a couple of weeks back, if you read those, forward earnings are trading anywhere from 13 to 14 times. That's pretty cheap, frankly. So valuations are fair, if not compelling. And so now that we've got earnings again, we can just do math. So on the operating earnings side, we should earn somewhere between 70, 80 bucks this year on the S&P 500. A fair market multiple, even if you get to an unsubsidized 10-year bond equivalent of 5.5 or something like that, would be somewhere between 16 to 18 times earnings. We closed today at 1,100 on the S&P. Doing the math suggests that fair value for the S&P based upon this year's earnings should be somewhere between 1,120 and 1,440. Higher part of that range as optimism builds, lower part of that range as pessimism builds. All right, so let's talk a little bit about expectations. Consumer sentiment is improving, albeit from a historically low level. We got kind of negative readings on that the other day, reacting to, again, negative news flow, but nonetheless, we are off of the lowest readings for the cycle. What about the fear level? Well, you know, we peaked in terms of total panic in November on the 20th of 2008 with the VIX, the volatility index, up at 80. Now we're back at more normal levels. So there is not panic out there. There is concern, but there is not panic. In terms of retail investor confidence, basically this chart tells you that 26% of retail investors are bearish. That's pretty low. But only 34% are bullish. That's also pretty low. So that's a push. What about investment returns? All right, let's play a little game. Let's call it breaking even. All right, on the 9th of October of 2007, the S&P peaked at 1565. The low reached on March 9th of 2009 was 677. We ended the year basically where we are today. Okay, how many people in the room think it'll take 10 years to get back to even? Okay. How many of you think it'll take 5 years to get back to even? Nobody? How about 3 years to get back to even? All right, so if it's 3 years to get back to even, that may feel like a long time, but it means we're going to compound at about 14.5% a year going forward. And so the most pessimistic response I've gotten to this is, David, it's going to take 10 years. It's going to take 10 years. Well, if it does, we're going to compound at 6% a year, which is better than the long-run rate of return for the bond market. And so it may take a while to get back to where we were, but it's going to feel a whole lot better than it's felt lately. All right, let's look at a couple big events that could happen this year and see if they give us any indication of the direction of investment returns. So likely this year, the unemployment rate will peak. Likely this year, the Fed will begin tightening. What does it look like 6 months later? Well, after the unemployment peaks, the S&P 500 historically is about 8% higher. After the Fed begins tightening, the market's 16% higher. Now, if you watch CNBC, which is dangerous, and I should make all clients sign a form that says, I will not watch CNBC, but if you watch it, what you'll hear is market commentators basically say, if the Fed raises rates, we're all going to die. Well, it's not the beginning of a Fed tightening cycle that mortally wounds markets. It's the culmination of a Fed tightening cycle. If the Fed does tighten, what they're going to indicate to all of us is that, hey, we are growing. They'll acknowledge that, and I think that could be good for the market. So you can see 24 months after the Fed begins tightening, market's up 34%, at least through the last few cycles. There's another thing I hear a lot on TV, which is that if the dollar goes down, the market goes up. If the dollar goes up, the market goes down, and that's the correlation. Well, let's go back and look at history. Between 1985 and 1995, the dollar fell basically 50%. The S&P went up 190%. Good times. 95 to 2001, the dollar went up 40%. The S&P went up 140%. I did well in stats, but you didn't have to take stats to know that that's pretty inconclusive. And so I would tune out CNBC in general, but comments on the dollar specifically. So the reality is good. Expectations have risen, but they have not risen, I don't believe, to the level of reality. And so there is room, yes, for investment returns. Modest, perhaps, but we'll take them and improve upon them if possible. So our forecast, our bold forecast for 2010 is that this is a market that is guilty until proven innocent. And what I mean by that is this market is awash in skepticism. Okay? And so we're going to get 4 meaningful reports this year, and that's earnings season. The rest of it is just noise in between earnings season. I mentioned it in email. It'd be great if the market was only open 4 days a year. Doesn't work that way. I apologize. In terms of equities, like I said, we think equities can grind higher at the pace of earnings. We do favor small caps over large caps. Think that continues. There's a lot of cash out there that's good for M&A. There was some today. Nobody noticed it. It was a huge deal. In terms of style, it could be the year where the financials come back to life a little bit. They are typically located in the value quadrants. We think value probably outperforms growth. In terms of domicile, the U.S. is going to have a lower growth rate than some of its international peers, but if the dollar's strengthening, then that's U.S. favorable, so it's kind of a tie, I think. In terms of the U.S. interest rates, we expected short-term interest rates will rise and that the curve will indeed flatten. And that the U.S. dollar will strengthen, as we've mentioned. And in terms of bonds, unless you disagree, and if you do, talk to me after. Don't do it in here, please. But we'll stick with corporates. Thank you. All right. So that is around the world in the economic sense. Now I'm going to touch the third rail and move into a discussion on policy.